Hi, welcome back to the channel, or if you're new here, welcome to it. Today, I don't want to talk about gaming or creative media like writing, and it's not about censorship either. We all know what's going on with Visa, Mastercard, Steam, Collective Shout, so I'm not going to rehash what's being discussed on every other channel. What I do want to talk about is what happens when pressure meets profit, and how this controversy that's brewing within Steam and how it could signal one of the most significant inflection points in modern finance. If you're an investor in Visa, MasterCard, or ETFs like Vanguard or BlackRock, or if you're even just someone watching the growing tension between free expression and corporate compliance, then this is a conversation that you cannot afford to ignore. So, what if you don't know? Here's what's happening. Recently, Steam, which is one of the largest PC gaming platforms, it found itself under intense scrutiny after a campaign by Australian advocacy group Collective Shout. Their goal was to pressure Steam to remove certain games that they felt were inappropriate, which many were controversial, but they were not illegal, and it worked. But here's the twist: it wasn't the campaign alone that forced Steam's hand, it was the payment processors, Visa and MasterCard, who leaned into it. And according to multiple credible sources, Steam was pressured behind the scenes to delist games or face financial consequences. That's right. Platforms that rely on credit card processors were suddenly subject not just to the law, but to ideological approval from private institutions. And this is where the dominoes start falling. Because Steam and Valve, they're not helpless. With $5 billion estimated in 2023 revenue and a profit margin near 40%, they've got options. They've already started operating in a closed loop store credit system with the Steam wallet, but they could take it one step further, and that is with a stablecoin. Or we'll just pretend that they call it the Steam coin. And Steam, they could bypass Visa, MasterCard entirely. No fees, no content restrictions, no middlemen. Now, imagine what happens if Steam does this and it works. Would Netflix, a platform constantly under a fire for controversial content, follow suit? Would Amazon, which already operates its own payment ecosystem, decide to tokenize Prime? What happens when major digital platforms decide to take control over their own financial rails? Not just to improve revenue, but to ensure operational sovereignty. The financial ripple system would be enormous. We're talking about trillions of dollars in transaction volume shifting off of traditional rails. And for investors like me, while I might be small time, in companies like Visa, MasterCard, and the various exchange traded funds, that's not just a disruption, that is a systemic threat. And I want to go ahead and play a deep dive that I generated from Notebook LM, which will unpack exactly how this might happen. It'll walk through the data, the technology, the financial motivations, and why this is not a fringe conspiracy or a tech daydream or something about, cryptocurrency financial bros, which I am not one of those. This is a real risk, and it's already starting. Thank you.
Welcome to the Deep Dive, the show where we really dig into a stack of sources to pull out the insights and knowledge that matter to you.
That's right.
Today, we're embarking on a deep dive that kicks off with something that might sound really specific, almost niche even.
hmm
We're talking about a debate over content moderation on a big gaming platform.
Okay.
Now, you might be thinking, gaming platforms, content rules, what's that got to do with me?
Fair question.
But here's the twist. This seemingly narrow issue, it has this surprising, really quite significant potential to shake up the very financial foundations of our digital world.
It really does.
We're talking about forces that could genuinely impact, say, your retirement fund.
Yeah.
And it points to a major blind spot that a lot of investors, maybe even regulators, aren't really seeing yet.
That's exactly what we're aiming to unpack today.
Yeah.
We're going to explore this really fascinating, but also, let's be honest, potentially disruptive idea, where some of the world's biggest digital platforms are seriously thinking about and maybe even starting to build their own payment systems, specifically stablecoins.
Stablecoins, right.
And the whole point is to sidestep the traditional guys, Visa, Mastercard, the payment processors we all use.
So cut out the middleman, basically.
Completely. Our focus today is on a hypothetical, but we think incredibly plausible concept we're calling Steamcoin.
Steamcoin, okay, tied to the gaming platform, Steam.
Exactly. And we'll explore the huge ripple effect that could trigger far beyond just gaming. Think e-commerce, streaming, even your own investments.
So our mission then is to guide you through this pretty complex web. We want to help you understand the incentives driving this potential change, how surprisingly easy it seems to be to actually do this now.
Technologically speaking, yeah.
The systemic risks that come with it, and most importantly, what it all means for you. Whether you're just buying stuff online, investing for the future, or just trying to make sense of this digital economy we're all in.
And for this deep dive, we've gathered quite a range of material. Detailed financial analyses of the big tech and finance players, a pretty eye-opening investor risk memo that flagged some of these unpriced exposures.
Unpriced exposure, oh God.
Company profiles, and some deep reports on stablecoin regulation, or lack thereof, and the tech behind them. It really connects dots you might not expect.
All right, let's dive in. So where do we start? The unlikely catalyst, you said.
We start with Valve Corporation.
Valve. Okay, most people probably know them for games like Half-Life or Portal, or definitely the Steam platform itself.
That's the one. Founded back in '96 by Gabe Newell and Mike Harrington, based near Seattle in Bellevue, Washington.
No, the really crucial thing to get about Valve right off the bat is that it's a private company.
Absolutely critical.
And that's not just like a trivia point. It shapes everything about how they operate, doesn't it?
It really does. Unlike public companies,
Yeah.
they're not constantly chasing quarterly earnings reports or answering to shareholders demanding immediate results. They don't have to release audited financials.
Which gives them freedom.
A huge amount of freedom. Freedom to innovate, to make big long-term bets, even if it means short-term costs, without that constant public pressure.
And they do this with a surprisingly small team, right? For their size?
Remarkably small. Estimates are somewhere between, say, 360 and 500 employees, which is tiny for a company with their kind of global impact.
That lean structure plus being private must make them incredibly agile.
Immensely agile. And yes, their core business is overwhelmingly Steam, launched way back in 2003.
And Steam isn't just a platform, it's the platform for PC gaming.
Without a doubt.
Yeah.
The dominant force. Sources consistently put its market share at, what, 70, 75%?
70 to 75%, that's huge.
It's massive. And when other developers sell their games on Steam, Valve typically takes a 30% cut.
30%, wow.
Think about that. 30 cents on every dollar spent on the biggest PC game store. Plus, they make their own hit games, like you mentioned. Half-Life, Portal, Dota 2, and now they're into hardware too, with the Steam Deck being super popular.
Okay, so they're diversified, but Steam is the engine. What about the financials? Even without public reports, we have estimates, right?
We do, and they are seriously impressive. For 2023, Valve's estimated revenue was around $5 billion.
$5 billion, okay.
But here's the really stunning part. The estimated profit margin.
Yeah.
Around 40%.
40% margin on $5 billion.
That translates to about $2 billion in profit for a private company with maybe 500 employees.
Incredible. And Steam is driving most of that.
About 90% of total revenue comes from Steam.
Yeah.
So yeah, when we talk Valve's power, we're really talking about the Steam financial engine. This is a company swimming in cash with huge strategic flexibility.
Right. So massive financial strength, private ownership, that puts them in a unique spot. And our sources suggest this connects back to that content moderation issue.
Exactly. This is where it gets really interesting. One source, the one titled Steamcoin Could Break the Financial System, highlights this growing pressure point. Steam faces increasing demands from various groups, activists, but also, crucially, from the payment processors themselves.
The Visas and Mastercards.
Yes. Pressure to remove certain types of content. And it's not always the illegal stuff. Often it's content deemed, taboo or controversial, even if it's perfectly legal.
Like what kind of content?
Well, the source mentions it's shorted maybe with adult content, then spread to certain horror games. But it raises the question, what's next? Political games, satire, old games with outdated themes.
That's a tricky slope. So the payment processors are effectively becoming content police.
That's the dynamic the source points to. These traditional third-party processors, Visa, Mastercard, PayPal, they become de facto gatekeepers.
How? By threatening to pull their services.
Precisely. They can use their essential role in processing the payments to exert influence, basically saying, hey, Steam, remove Game X or we might stop processing your payments.
Wow. That's serious leverage.
It is. It can involve threats of being delisted, fines, or just major reputational damage if they don't comply.
But, and here's the key bit, Valve is different.
This is the absolutely vital point. Valve doesn't have to bow to that pressure in the same way a smaller, maybe publicly listed or less profitable company might.
Because they have the money and the independence.
Exactly. They are big enough, profitable enough, and private enough to realistically consider just building their own financial plumbing, their own payment system.
They could just walk away from Visa or MasterCard if they wanted to.
That's the unique power they possess. It sets them completely apart. They have the credible option to go it alone.
Okay, so they can do it, but why would they? What's the incentive? Is it just about avoiding those processor demands?
Well, that's part of it, the strategic control aspect, but there's also a massive financial incentive. Let's look at the current costs.
Okay.
Steam takes payments through Visa, MasterCard, PayPal, various local systems, gift cards, a whole mix.
Right.
For that roughly $5 billion in annual transactions, Valve is estimated to be paying around $125 million a year in fees to these processors.
$125 million, just in transaction fees.
Yep. Based on an average fee of maybe 2.5%. It varies, but that's a reasonable ballpark.
Okay, $125 million. Now, you said they make $2 billion in profit. So, I mean, is $125 million really that big a deal? Seems like a cost of doing business, maybe. A drop in the bucket, almost.
It's a fair point. Right. You might think that. But remember, this is a private company focused on margins. $125 million is still $125 million straight to the bottom line if they could avoid it.
So, eliminating those fees, that would directly boost their profit margin.
Significantly, by an estimated 6 to 10%. On top of an already stellar 40% margin. That's a material impact, even for them.
Okay, that's a solid financial reason. But you mentioned strategic control earlier. Is that the bigger driver here, according to the sources?
You hit the nail on the head there.
Yeah.
While saving $125 million a year is, obviously very attractive.
Can't complain about that.
No. But the sources strongly suggest the financial savings are actually secondary. The real prize is strategic control.
Control over what, exactly?
Everything.
Yeah.
End-to-end control over their whole monetization strategy. Imagine it. Complete freedom in how they bundle games or content, how they structure loyalty programs, how they engage directly with users without any intermediary.
And the data.
And owning all the transaction data directly. It's not just about saving money on fees. It's about building a truly closed-loop ecosystem.
Giving them way more flexibility, power in their market, less vulnerability to those outside pressures.
Exactly. And deepening that direct relationship with their millions of users. It's about autonomy.
Right. Seizing strategic autonomy. Less about trimming costs, more about building their own financial destiny, almost.
That's a good way to put it.
Okay, that makes the Steamcoin hypothesis sound much more compelling. So, let's get into it. What is Steamcoin conceptually, and how would it actually work?
Right. So fundamentally, Steamcoin would be a type of stablecoin.
Okay, stablecoin. We hear that term a lot. Remind us of the basics.
Sure. Stablecoins are a specific kind of digital asset, a crypto asset, but designed for one main thing, keeping a stable value.
Unlike Bitcoin or Ethereum, which jump around like crazy.
Precisely. Stablecoins aim to avoid that volatility. They're usually pegged, often one-to-one, to a reserve asset, most commonly the US dollar.
So one Steamcoin would always be worth, say, $1.
That's the idea. You get the stability and trust of regular money, but combined with the potential efficiency, speed, and programmability of a digital token.
Okay. And there are different kinds of stablecoins, right? Some safer than others. Which type would Valve likely use?
Yeah, that's crucial. For something like a Steam coin from a major platform like Valve, the only really sensible and responsible option is a fiat collateralized stablecoin.
Fiat collateralized, meaning backed by actual money.
Exactly. Every single Steam coin they issue would be backed one-to-one by real US dollars or very safe liquid assets like short-term government bonds held in audited reserves.
Like USDC or the PayPal dollar uses.
Precisely those models. They aim for transparency and full backing. The other types, well, there are crypto-collateralized ones backed by other cryptos, often needing more collateral than the coin's value, like DAI.
Sounds riskier.
It can be more volatile. And then you have algorithmic stablecoins. They try to maintain the peg using smart contracts and algorithms without direct backing.
Like Terra Luno. That didn't end well.
Exactly. Many algorithmic stablecoins have collapsed spectacularly, wiping out users' money because they lack that tangible reserve backing. So for a big reputation-conscious company like Valve, fiat collateralized is really the only way to go to maintain trust and meet likely regulations.
Okay, so backed by real dollars, audited reserves, that makes sense. But still, the idea of Valve just creating its own currency, it sounds like this massive, complex project. Years of work, specialist teams.
You'd absolutely think so, wouldn't you? It sounds like launching a bank.
Yeah, but the sources say, it's easier now.
Shockingly easier. One source, the ease of stablecoin creation for digital platforms, really emphasizes this point. We're not in the early days of blockchain anymore.
The tech has matured.
Massively. There's a ton of readily available, mature, open source software and tools. Frameworks like Ethereum, Polygon, Solana, they offer stable, well-documented ecosystems perfect for creating tokens.
So Valve wouldn't need to build everything from scratch.
Not at all. They could hire a specialized Web3 development firm or, honestly, just use their own internal software engineers. Yeah. They could deploy a functional stablecoin in weeks.
Weeks, not years.
Weeks. Standard smart contract templates, like the ERC-20 standard for basic tokens, or ERC-1400 for security tokens. They're publicly available, already audited by the community. You just need some customization.
One source even gave an example, right? Using common code.
Yeah, it showed how a basic working stablecoin could be deployed with common tools like Python and Solidity in less than 100 lines of code.
Under 100 lines of code. That's almost trivial for a company like Valve.
It really highlights how low the technical barrier has become. What used to be rocket science is now, for a major tech company with their resources and engineering talent, almost a routine project.
Okay, less than 100 lines of code. That's kind of mind-blowing. For someone not in tech, that sounds more like a quick script than a financial revolution.
Yeah, it does frame it differently, doesn't it?
Does this technical ease mean these closed systems could pop up faster than regulators can even react? Is that part of the blind spot issue?
That is precisely the critical issue and where the regulatory blind spot really starts to bite.
Okay.
The ease of creation means speed. Platforms can move much faster than traditional financial institutions, and definitely faster than the regulatory bodies trying to oversee them.
Creating a gap.
A big one. It allows for potential regulatory arbitrage. New, large-scale financial systems could emerge and grow significantly before regulators fully understand what's happening, let alone create rules for them.
What does that mean for stability? Or for the traditional players?
Well, for market stability, this rapid, potentially under-regulated growth of parallel payment systems could introduce new risks around consumer protection, money laundering, maybe even liquidity if they get big enough. And for traditional finance, it's a clear threat if the biggest platforms can just spin up their own payment rails this easily.
It cuts the legs out from under the processor's business model.
Exactly. The whole competitive landscape could shift dramatically very quickly if someone like Valve proves the model works. Months, not years.
All right, so the tech is there. It's surprisingly straightforward to build. But what about plugging it into something as massive as Steam, making it work seamlessly for millions of users? Is that part hard?
Actually, that's probably one of the easier parts for them.
Really? Why?
Because platforms like Steam already control the entire user experience. The digital storefront, the in-app purchase systems, the software client on your computer, they own it all.
They have the direct connection to the user.
Exactly. Think about the Steam wallet. Many users already load money into it to buy games.
Right, I use that.
So that existing wallet could just be upgraded natively to hold and use Steam Coin instead of just dollars or euros.
So it wouldn't even feel that different to the user.
Potentially. Very little difference. Wallet features can be built right into the launcher they already use, minimal friction. Users are already used to digital balances and buying things within the platform.
And could they be clever about how they roll it out? Maybe link it to loyalty points or something first to avoid immediate heavy regulation?
Precisely. That's a key strategic design choice. They could tie it to existing systems. Users already understand loyalty points, subscription perks, maybe limit its use initially to just in-game items within the Steam ecosystem.
Make it look less like a real currency at first.
Exactly. Frame it as an enhanced store credit or a gamified reward, not a direct competitor to the dollar right out of the gate. That could potentially lower the regulatory heat initially, letting them build adoption while they navigate the rules. It's iterative.
Okay, that makes strategic sense. Beyond the tech and the integration, there's also the cultural fit, right? Especially in gaming. Gamers are used to virtual money.
Absolutely. That's a huge built-in advantage. In-game currencies, virtual economies, digital items. This is second nature for most people on Steam.
They get it already.
They totally get it. So introducing a proprietary stablecoin feels more like a natural evolution of what they already do, not some weird new financial thing they have to learn. It dramatically lowers the barrier to adoption.
And what about the game developers? Do they benefit?
Potentially, yes. Publishers and developers might actually prefer getting paid directly in Steam coin. Think about international sales. It could slash cross-border payment friction, get rid of currency conversion headaches and delays.
Faster, cheaper payments for them, too.
Exactly. And if Valve is cutting out the processor fees, maybe some of that saving gets passed down, improving developers' margins, too. It could create a win-win for Valve and its content creators, strengthening the whole ecosystem.
Okay, so if Valve pulls this off, saves money, gains control, makes users and developers happy, this stops being just a gaming story.
Instantly.
It sets a huge precedent. The sources call it a contagion risk, right? A domino effect.
That's the core idea. If Valve, this kind of unique private gaming company, proves this model works and brings massive benefits,
Every other big digital platform is going to notice.
they'll notice immediately. The economic logic plus the now proven tech feasibility becomes almost irresistible for any platform handling large payment volumes.
Okay, so who's next in line? Who else fits that bill? Netflix has got to be high on the list.
Absolutely. Netflix, streaming giant. Think about their numbers. $37.5 billion in revenue in 2023. Around 260 million subscribers worldwide.
All paying monthly, mostly?
Mostly recurring monthly payments, yeah, averaging around $12. And how do they collect that? Almost entirely through Visa, Mastercard, Amex.
So they need reliable, global, multi-currency payment processing.
Critically. And you can bet they pay enormous fees for that privilege.
So the incentive for a Netflix coin seems pretty obvious. Just slash those recurring payment fees.
That alone would be huge. We're talking potentially hundreds of millions saved annually by cutting out that 2-3% fee on every single one of those 260 million subscriptions every month.
But is it just about saving money for Netflix? Or are there other strategic plays a Netflix coin could unlock?
Great question. The cost savings are compelling, no doubt. But for Netflix, a proprietary coin could open up completely new ways to bundle content and engage users.
Oh, so.
Imagine moving beyond just a flat monthly fee. Maybe you use Netflix coin for micropayments, pay a tiny bit to watch exclusive behind-the-scenes stuff, or a director's cut, or maybe unlock interactive story choices in a show.
Ah, okay. More granular pricing.
Or think about loyalty. Earn Netflix coin for watching certain things, for binging a series, for rating content. Then spend those coins on premium features, early access, maybe even exclusive merch.
Deeper engagement, more loyalty.
Exactly, a more dynamic ecosystem.
Yeah.
But, and it's a big but, the regulatory hurdles and the trust barrier would likely be much higher for Netflix than for Valve.
Why? Broader audience.
Much broader, more mainstream audience. And messing with payments for what people see as a basic household service, that's going to attract way more scrutiny from regulators and consumers alike.
Okay, so Netflix is big, but then there's Amazon, the absolute behemoth. What about an Amazon coin? That sounds game-changing.
Game-changing is an understatement. Amazon's 2023 revenue, $575 billion.
Whoa!
Over 200 million Prime members. Their e-commerce payment volume just dwarfs everyone else we've talked about, orders of magnitude bigger.
And unlike others, they already have payment infrastructure, right?
Exactly. They're not starting from zero. They have Amazon Pay operating globally. They issue billions in gift cards and store credits already. They know how to manage internal digital balances at scale.
So they're perfectly positioned. What would an Amazon coin enable them to do?
Amazon could build a truly enormous, almost inescapable, closed-loop token economy. Think about it. An Amazon coin used not just for buying stuff on Amazon.com,
But for AWS Prime Video, Alexa.
Across the entire empire, retail, cloud services, streaming devices, the impact would be revolutionary.
The fee savings alone must be astronomical.
Hundreds of millions, easily. Maybe billions saved annually on card processing fees. A direct massive boost to their profits.
And beyond fees.
It would massively increase user lock-in. If your digital cash is tied up in Amazon coin, are you really going to shop elsewhere?
Good point. Stickiness.
And the data. Unparalleled insights into spending across every single part of their ecosystem, that's incredibly valuable.
This sounds like it poses a huge risk to, well, everyone else.
It really does. A significant systemic risk. To Visa and Mastercard, obviously. To the millions of small sellers on Amazon who rely on traditional payments. And to regulators who lose visibility into a massive chunk of commerce and face huge oversight challenges.
Wow. So the scale of potential disruption here is just immense. Far beyond gaming or streaming, this could reshape global commerce.
That's the potential.
If this contagion really spreads Valve, then Netflix, then Amazon, what are the broader implications?
The combined impact is staggering. Just Netflix and Amazon together are over $600 billion in annual revenue.
Right.
If even, say, 20% of their payments moved on to their own proprietary coins off the traditional rails,
Visa and MasterCard would feel that acutely.
it would be a huge measurable blow to their revenue.
Yeah.
But maybe more importantly, it would be profoundly symbolic. It would signal a fundamental power shift in the digital economy
A shift away from those centralized payment networks we rely on now.
towards potentially fragmented, platform-specific walled gardens. And remember, the Steam coin source even mentioned a hypothetical Disney coin.
Disney. Wow.
It underscores the point. The economic logic applies to any large digital platform with huge transaction volumes looking for more profit and control. It's not industry-specific.
Okay, so Valve, Netflix, Amazon, maybe even Disney. We're talking about economic entities that rival nations. Are we heading towards a future where our digital money is fragmented across these tech giants? What does that do to, like, just buying things easily?
That is the multi-trillion-dollar question, isn't it? Their combined economic clout is immense. And yes, if each builds its own coin, that seamless interoperability we take for granted with credit cards could definitely start to break down.
So instead of one card working everywhere, I need a wallet full of different coins.
Potentially. You might need Steam coin for games, Netflix coin for movies, Amazon coin for shopping. Transactions within each platform might become smoother, maybe even cheaper for you as a consumer there.
But moving money between them gets harder.
Could introduce new friction.
Yeah.
For global commerce, it signifies a massive power shift from banks and payment networks to big tech, controlling not just the goods and services, but the money itself.
And for the average person,
It could mean a more complex financial life, maybe some benefits like tailored loyalty programs or discounts within specific ecosystems, but also maybe less freedom and more lock-in. It's a huge trade-off that could reshape everything.
which brings us squarely to the impact on the traditional financial system. If these giants build their own rails, what happens to Visa and MasterCard? And importantly, what does it mean for investors, maybe like you listening, who own these stocks?
Visa and MasterCard are, without question, dominant forces today, but that dominance makes them incredibly vulnerable to this kind of disruption.
Let's look at their size again.
Okay, Visa, 2023 revenue, $33 billion, net income, $17.3 billion, operating margin around 52%, just huge profitability.
And MasterCard.
$25 billion revenue, $11.2 billion net income, operating margin about 45%. Again, incredibly profitable.
And they make this money by taking a tiny slice of almost every card payment globally.
Exactly, including all those billions flowing through Steam, Netflix, Amazon. They are the essential plumbing, taking a small cut of a massive flow.
So their whole business model relies on that digital transaction volume.
Fundamentally, it's built on network effects and volume. So every major platform that decides to build its own system and bypasses them.
It's a direct hit to their core business.
A direct hit. Steam alone, we estimated $125 million in fees lost. Now imagine Netflix doing it, Amazon doing it, Disney. You're talking hundreds of millions, potentially billions, in lost processing volume. Gone.
That has to undermine their valuation, right? Which is based on continued growth in those fees.
Absolutely. It directly attacks the core assumption underlying their market value.
And this isn't just some abstract corporate issue. The sources really stress the risk to individual investors, maybe even unknowingly.
This is a critical point, and one the investor risk memo source really hammers home as being overlooked.
How so?
Visa and Mastercard aren't just niche stocks some people own, they're blue-chip behemoths. They are top holdings in the most widely owned index funds out there.
Like S&P 500 trackers, tech ETFs.
Exactly. Think Vanguard VOO for the S&P 500, Vanguard VGT for tech. Millions upon millions of people hold these funds in their retirement accounts, their 401ks, regular brokerage accounts. They are passively and significantly exposed to Visa and Mastercard's fortunes.
And the memo had that stark comparison with Valve.
Yeah, it pointed out that Valve, just by itself, if it handled its own payments, represents a revenue stream potential that's like 60% of the size of Visa or Mastercard's own revenues. That shows how much volume just one big platform contributes.
So if Valve does it, and others follow, the risk multiplies across all those passive investors' portfolios.
Dramatically amplified. It's a hidden concentration risk for many diversified investors.
And the memo calls this a blind spot. Why? Why isn't the market seeing this, pricing it in? Is it just too new, too different from historical risks?
That's precisely the argument. The Steamcoin could break the financial system. Source contends this systemic risk is not currently factored into market prices.
People aren't ignoring it, they just don't see it.
Largely, yes. The market tends to rely on established patterns and past data. Payment processors have always been seen as safe bets, the toll booths of the digital economy.
Right.
What's fundamentally new is the scale and, crucially, the technical ease with which platforms like Valve or Amazon can now build their own alternative roads. That capability just wasn't commercially viable a few years ago.
So there's a disconnect. Finance analysts don't get the tech speed. Tech analysts don't get the financial ripples.
That's a big part of it, a mismatch in perspective and risk assessment between sectors. And passive funds, by definition, don't actively trade based on anticipating these kinds of huge structural shifts. They might only react after the damage is done.
Which means the correction, if it comes, could be sudden and painful.
Potentially.
Yeah.
And any big disruption in payments wouldn't just hurt financial stocks. It would ripple through tech, maybe cause broader market instability. It's this looming, unpriced risk.
That is genuinely concerning, especially thinking about retirement savings tied up in broad funds. Which leads us to the biggest blind spot, the regulators. Why is this massive potential shift seemingly flying under their radar?
Well, the regulatory world here is complex and fragmented. You've got several U.S. agencies with overlapping jobs when it comes to digital assets and payments.
Like who?
You've got the SEC, the Securities and Exchange Commission. They're looking at whether these platform tokens count as unregistered securities. That's a huge deal, triggers tons of rules.
Right.
Then the CFTC, Commodity Futures Trading Commission. They handle derivatives, commodities. They might get involved if tokens are used in futures or certain other markets.
Right.
Then there's FinCEN, Financial Crimes Enforcement Network. They're all about anti-money laundering, AML, and Know Your Customer, KYC rules,
Right.
preventing crime.
Crucial.
And finally, the Federal Reserve and the OCC, the Office of the Comptroller of the Currency. They oversee banks, monetary policy, and the big picture.
Yeah.
Systemic risk to the whole financial system.
Okay, lots of cooks in the kitchen. And we have seen them act before, right? Like with Facebook's Libra.
Libra, later called Diem, is the absolute key precedent here. Proposed back in 2019, meant to be this global stablecoin.
And it got shut down hard.
Completely abandoned by 2022 due to intense, coordinated pressure from regulators and central banks globally. It showed they can act decisively when they see a big enough threat to financial stability or government control over money.
But things have evolved since Libra, haven't they? There are compliant stablecoins now.
True. The landscape isn't static. We now have models like PayPal USD, PYUSD, launched in 2023. It's backed by dollars and treasuries, operates under state money transmitter licenses, gets audited. Circle's USDC is similar.
So there are ways to do it right in the eyes of regulators.
There are frameworks emerging, but then you have examples like Tether, USDT, which has always faced criticism of the transparency of its reserves, been investigated multiple times. That shows what regulators don't like. So it's a spectrum.
And we've seen enforcement actions against crypto companies too, right? The SEC versus Terraform Labs with LNA.
Absolutely. That case highlighted the massive risks of algorithmic stablecoins and showed regulators will go after platforms they see as misleading investors or breaking securities laws. There have been actions against exchanges like Kraken 2 over staking, so they're not totally inactive.
Okay, so there's activity. But the sources insist there's still a major blind spot, specifically around these platform-issued stablecoins from companies like Valve, which aren't traditional finance or crypto firms, Why?
This is the core of the regulatory concern. The investor risk memo points this out very directly.
What did it find?
It noted that neither Visa nor Mastercard mentioned the risk from platform tokens in their big earnings calls during 2023-2024. That's significant because public companies have to disclose material risks.
So the companies most affected aren't talking about it publicly.
Seems not. And maybe even more telling, the memo highlights that there's been no formal public statement from the SEC, CFTC, or the Fed specifically about proprietary stablecoins issued by unregulated tech firms for use inside their own platforms.
So despite Libra showing the potential danger, this specific flavor of it isn't getting official attention.
It appears not. Even though there have been years of congressional hearings digging into stablecoins generally, the focus seems to miss this specific threat from private, non-financial tech companies potentially creating large internal economies.
Interesting. So Congress has looked at stablecoins, but maybe not this specific type.
Yeah.
What have those hearings focused on?
Yeah, that seems to be the disconnect. Those numerous hearings from 2021 to 2024 really drilled down on a few key areas. The big picture risks to monetary policy and financial stability, especially from globally ambitious coins like Libra was meant to be.
Okay.
Consumer protection issues like what if the issuer goes bust or the coin loses its peg.
Yeah.
It worries about illicit finance, money laundering, terrorist finance.
Well, valid concerns.
Definitely. And reports from major groups, the President's Working Group, the GAO, Treasury, they've all emphasized needing clear rules, especially around reserve transparency and strong oversight for stablecoin issuers.
Good.
But the conversation has mostly been about stablecoins as a general asset class, often those aiming for broad public use are offered by crypto exchanges. The specific nuance of a platform-specific token issued by an unregulated tech giant may be initially disguised as loyalty points or in-game credits.
That seems to slip through the cracks.
It seems to. These platforms might avoid immediate scrutiny because their tokens don't look like direct dollar competitors at first glance, even if the transaction volume inside their ecosystem eventually becomes enormous, potentially rivaling small banks. This gray area, combined with how fast tech moves, leaves this potential systemic risk largely unaddressed by current regulatory frameworks. It's a glaring oversight.
Okay, so we've connected a lot of dots here. Started with game content rules, ended up potentially shaking the global financial system. Let's bring it back home. What does this complex picture mean practically for you listening right now?
We really have traced a wild path, haven't we? From content pressure on Steam acting as this unexpected catalyst,
Right.
to the surprisingly easy tech allowing platforms to create their own money,
Stablecoins.
leading to this potential domino effect across e-commerce, streaming, which then directly threatens the core business of giants like Visa and Mastercard.
And through them, our own investments.
Exactly. And often, potentially, without us even realizing that exposure, the interconnectedness is really key here.
And the main takeaway, the big flashing light, is this idea of the unpriced risk.
That's it, precisely. The potential systemic hit from tech giants pulling their massive payment volumes off the traditional rails, it's just not currently baked into market valuations.
It's a hidden vulnerability.
A hidden vulnerability, a blind spot for many investors, especially, as we said, for people relying on passive index funds that might not react until it's too late. The market isn't accounting for this potential disruption yet.
Do the sources offer any solutions, any recommendations for how to deal with this risk?
Yes, the investor risk memo does suggest some concrete proactive steps.
Like what?
First, it says fund managers, especially the big passive ones, should start formally asking questions. Shareholder inquiries,
Pushing the companies.
pushing companies like Visa and Mastercard to publicly disclose how they're preparing for this platform token risk, get it out in the open.
Okay, transparency from the incumbents. What else?
Second, it calls on regulators to wake up and require disclosure from the platforms themselves, even private ones like Valve, if they're issuing these closed-loop tokens, especially as volumes grow. Shine a light on that opaque area.
Makes sense. Disclosure from both sides.
And third, it advises Visa and Mastercard themselves to get serious about defensive strategies and, again, be transparent with their own investors about the risks and their plans. Proactivity is vital. Waiting until it happens might be too late.
Because at the end of the day, this isn't just some abstract tech trend. It's a financial story with real-world consequences for your money.
Absolutely. If you have money in the market, whether it's individual stocks or more likely through ETFs in your retirement fund, your 401k, whatever, understanding this potential shift is genuinely important.
It helps you gauge the real risks in your portfolio.
And make more informed decisions about where your savings are and what forces might impact them in this digital age.
So, wrapping up our deep dive today on the Steamcoin hypothesis, we've seen how these really different forces, content fights, easy tech, pure financial incentives can all line up to create this powerful potential to disrupt the entire global payment system.
And it leads us back to that provocative quote from the Steam coin could break the financial system source.
Right, what was it?
The longer payment processors play content police, the more likely tech platforms will build their own rails.
That really frames the dilemma, doesn't it?
It does, and it raises these huge questions about the future. Who controls the flow of digital money? Do we get more innovation and lower costs from these platforms competing with banks? Or do we end up with a fragmented system of powerful walled gardens?
Each with its own money, maybe harder to move between, maybe less consumer protection.
Possibly. What happens to financial interoperability? What happens to consumer rights when your money is tied up in Amazon coin or Disney coin? It's a massive shift in power from finance to tech.
Definitely a space to watch very, very closely.
Indeed, the implications are enormous.